Well, good morning or good afternoon, everybody, and thank you for joining us for our 9th Calm COVID Convo. Today, we're going to hone in specifically on real estate industry, specifically on real estate businesses, and all the various considerations around COVID on their business. Now, we've got a lot to cover today, so we're going to sort of power through it. But as always, we'd love to get your questions. The more questions, the better. The more that we can answer your practical, real-life questions, the more beneficial for everybody else, and hopefully the more beneficial for you. Of course, the whole idea of the Calm COVID Convos is to take all the stress, take all the hype, take all the drama out of the discussions that we're having around this. We don't need to be dramatic. Let's just calmly think about what we've got, what are the issues at hand, and have a casual conversation about the different options that are available to us in our businesses. Now, of course, joining me today, you'll notice we don't have Rebecca Mahalik with us today, and she's been replaced today by Craig Harrison. Welcome, Craig.
Hey, John, how are you?
Good. Craig's the head of our real estate accounting and advisory offering. And so we've got him on today to talk about all the different questions he's been asked with all his real estate agency clients. And for the first half of today's convo, we've also been joined by Justine Ansell. Justine is a specialist employment lawyer, focuses in not only on fair work sort of side of things, disputes, and all of that, but we need that lawyer on here to answer all those technical questions, don't we, Justine?
We do. Thanks, John, and hello, everyone.
And as always, with any of these sort of legal matters, as we dive into them, I mean, we will give our view on different things. There might be things that we can't obviously give an opinion on because it might come back to your specific agreements, but let's at least have a conversation around the different perspectives and how you could potentially apply that within your businesses. So let's get into it. So real estate industry, obviously it is one of the industries that has been impacted by the coronavirus and by the shutdown and cancelling open houses, or at least the group open houses and those types of things. But it does have the advantage of a bit of lead indicators as to what's going on as well, in that, you know, they're still getting some income for the contracts that were signed last month. So with that in mind, Craig, and all the different questions that you're being asked, and especially in this hectic week around JobKeeper payments today, what are the biggest things that you're being asked about at the moment?
Well, John, you're right. It's been unrelentingly about JobKeeper over the last couple of weeks, but and probably justifiably, because this is a reasonably big subsidy for businesses at the moment, when they can see that their revenue is going to, fall off a cliff for a lot of people over the next, probably 6 weeks is probably the end point where people are seeing them drying up really significantly. So the big questions are about: do I qualify? How do I qualify? What's this? There's a turnover test. To qualify for JobKeeper, your revenue needs to have dropped by more than 30% over a relevant period compared to last year. And so people are scrambling to try and figure out, do I qualify now? When am I likely to qualify? And building up their business plans around that.
So what are the big ticket items in applying that 30% test, Craig, that you're sort of coming across with the different real estate businesses?
Well, it's how to quantify whether or not 30% has happened. So the big questions that we're seeing are, and you led into it quite well, John, that the people have got a good sort of forecast forward because they're still getting revenue coming in April, May, and to some extent even June for some businesses on activity that had occurred in February, early March, before the whole world seemed to shut down. So right now people are writing a hell of a lot less business than they had been before. They can see the pain coming, but that may not necessarily translate through to an immediate drop in revenue, because they still have settlements rolling through the door. And so trying to figure out, well, okay, we've got some good settlements now, but does that mean we're going to qualify as of the 1st of April to start receiving these JobKeeper payments, because we can see the revenue cliff coming.
What about this concept of measuring it by written versus settled, or what are you saying to people to make sure that they're comparing apples with apples?
Well, I think the ATO has been pretty clear on it, John, in that their opinion is that it's a like-for-like comparison. And it's based on your GST reporting methods. So, if you've been reporting GST on your BASs on the basis of settled business, then you should be comparing the same thing in this current period compared to last year.
It doesn't mean you can't take your written into account, because there's also this projection sort of mechanism, isn't there?
Yeah, excuse me. Yeah, and I mean, there's also, to get qualified from the 1st of April, I think you've got to remember that you can look at the full quarter from April to June. So for a lot of businesses, that month of June is looking really, really lean. And so looking at that whole 3-month period and knowing what settlements you're coming up with, forecasting where that sits is really, really important.
Yeah, and maybe just to reiterate that for the audience. So to qualify for the JobKeeper payments for April, you need to either be 30% down on March compared to March last year, April compared to April last year, or the June quarter compared to the June quarter last year. Now, obviously, that's on a projected basis, and that's where that written sort of sales. The industry actually has the advantage of being able to see what settlements are coming, because you've got your different contracts and so forth around the corner.
Yeah,
there is
doing a lot of forecasting with that, where people are shooting through their sales CRMs, and you can see what's expected to settle when, and you can do a reasonably good plot out of what your revenue looks like. If that's how you've been reporting in the past, or for BASs, you can do the same again.
Yeah, and I mean, most real estate businesses that I've been doing the test with, and I'm also interested if you've been seeing the same thing, Craig, most of them are struggling to meet the 30% drop in April, because they went in pretty strong into this quarter. Many then fall off the cliff a fair bit in May and June, and so they're doing the projections for the quarter. But we do have some situations where they're not meeting it for the quarter, but they meet it from the month of May. So all that means is you just don't get the JobKeeper payment for the month of April. You only get it from May onwards, effectively.
Yeah, I'm seeing that a lot, actually. So for a lot of people, their April was fairly strong, and strong enough that even with May and June revenue falling away pretty substantially, it's not quite enough for the full quarter to be 30% down. And so we're seeing a lot of people qualify for 1st of May onwards, or, if it's not quite May, then often June.
Yeah. And of course, the 30% test we're talking about here is what they call the basic test, so the decline in turnover test. There has been talk of alternative tests, and there has been more information over the last couple of weeks to indicate the types of situations that we expect alternative tests to apply to. I know in the tax office information, they compared it to, say, a farmer who was in drought conditions last year, someone who bought a business during the year, or someone who, there was another example in there, Craig. It was bought a business or started a business.
Yeah, startups. Yeah. And the scale up that goes with that.
So we're expecting alternative tests to capture those sort of situations. What do you think about those businesses that have just been on a strong growth curve naturally, as to whether we think we'll get an alternative test for that or not, Craig?
Look, if I'm honest, I think it's going to be hard. I'm not sure that they will do that, because although they've set out some alternative tests, and it's basically down to commissioner discretion, all of the information that they've published has been very much around acquisition, startup, or something out of your control last year, which means that the revenue last year was not an appropriate comparison to this year. Look, I'd be hopeful, because I know there's businesses out there that have invested substantially in growing team, growing capacity, and that's a real investment. But I'm not necessarily sure that the ATO are going to come to the party on that.
Which means we're then left with this discretion sort of option. Now, we've had lots of people within the industry say, can you make discretionary application for me? The response to that is, we don't even know how they want to receive an application for discretion at the moment. We can get on the phone like Justine did last night, having a glass of wine, waiting for the ATO to answer your call after an hour. But unfortunately, we don't think that will be the process to get discretion on the application to be relevant for this. But that is a backup plan. Of course, one of the time critical factors with this is to get it for April. You need to register and have paid the minimum amount to your employees by the 30th of April. And then after that, it's a fortnightly sort of situation that you have to have paid it every fortnight, the $1,500 minimum within there. Maybe before we jump over to you, Justine, with some questions, we have had a couple of things pop up on the Q&A. So this question here: as we get paid a few months after a sale, it's hard to prove loss of income. A cafe has instant income loss straight away. How do we prove slow now, but cash is coming? I think we've sort of answered that one, Craig, haven't we?
Yeah, I think we have. That is the challenge that we've got at the moment, that we can see it coming, and the reality for a lot of businesses, we can show that it's going to be off, but it's about projecting when it's going to be off and what that means for a start date for your business.
Yeah, I mean, in real estate, you can do your sort of what your next couple of months look like. What are the listings that you've got? How many of them do you expect in the next little while to go to contract? And if so, what sort of settlement period that they have? So you've actually got more information than, say, many other businesses out there as to what your future income's going to be like. Wayne's asked if there is a 30% drop in sales rep income, or is it total office income?
Total office income, John. I was just about to say that some of the discussions I've had where people are talking about, look, I'm 50% down on sales, I'm going to qualify easily, that you do need to think about the fact that your property management revenue for most businesses is holding up okay. Your vacancies and arrears might be going up a little bit, but for the most part, they're holding up okay. And it is total income. You can't do it on a division unless you operate in separate entities. If you're operating in separate legal structures, then you may be able to. But if you are in one entity, then no, it is all of the revenue for your business.
Yeah, what might be common is one of property management in one entity and sales in another entity. They have to apply it separately in their two tests. If both divisions are in the one entity, it is the total of the two divisions together that's relevant for it as well. We've got a question. I opened up my office this time last year. I'm earning more than when I open, obviously. How do I process a loss of 30%? If you're a new business, we're expecting an alternative test for that one.
That's one of the three ones they sort of mentioned: startups, not fair comparison, or that you've acquired.
Yeah, Greg's got a question on there. What about fluctuation in property market conditions, i.e. in Vic last year, property market was still in serious decline in last year of FY19. Yeah, Greg, thanks for the question. Look, my response on that, Greg, I'm interested in your view on it as well, but unfortunately, I think if we're applying the basic test, there's going to be some winners and there's going to be some losers. And I think just from a general sort of nature, I don't think we're going to be able to sort of just lean on some of these market fluctuations that have applied in different geographical areas. And I think the test is 30% decline, and unless we can prove that, I think we struggle. Okay, question. Let's now go to, tied into these JobKeepers, Craig, what sort of types of questions getting specific on JobKeeper now? Are you getting?
Oh, look, probably over the last week or so, the biggest ones that I've been getting is how is this JobKeeper payment going to apply to commission-only agents and debit credit agents? That's the stuff that people are really trying to understand.
Okay,
and that's the challenge at the moment.
Okay, let's dive into that, and I'll jump over to you, Justin. I might even get you to start first, because I know there's been a whole raft of changes to the Fair Work Act. And I think some awards have sort of rolled through. Can you just give us a quick snapshot of what those changes were?
Yeah, sure. Thanks, John. So there have already been some changes to the real estate award that will apply to all of those real estate agencies that have dialed in today. So we now have the capacity for 2 weeks of unpaid pandemic leave. If you've got a real estate agent employee covered by that award, or maybe the Clerk's Award, for example, that is needing to self-isolate due to a government direction or medical requirement. So there's scope now for that unpaid pandemic leave. So that change came through a couple of weeks ago. There's also now capacity to direct employees onto annual leave. So previously, there were lots of restrictions around what you could do there. So the employee basically had to have excessive annual leave and you could only reduce it to a certain amount. So there's a little bit more flexibility there with annual leave and annual leave on half pay. You can agree to employees taking that on half pay. For the real estate award itself though, there has been an application made by the relevant bodies to seek to vary the review date for commissions, which is normally the 2nd of April, and obviously it's right in the middle of the COVID-19 crisis. So there's an outstanding application in the commission, which is going to be heard on, I think, the 7th of May, so very soon, to move that review date back to 1 October 2021. and then the new annual review date for commissions being 1 October. So that hasn't happened yet, but hopefully that will give some relief to agents out there if that gets through. There was an earlier submission when those unpaid pandemic leave provisions were coming in about changing MITRE, but that doesn't seem to have progressed that I can see. So it's just a case of keeping a watching brief on it. We can do an update on that as that happens. They're the main changes to the real estate award at the moment.
So some of the things we're seeing out there as to how people are dealing with their staff, there are still some staff that have been, there's some confusion around terminology, but there's been some staff that have been sort of stood down, which I understand that is no longer required to work, but they're still an employee accruing leave and those types of things. There's been people terminated, redundancy, those types of things. Is there anything we need to be aware of in that?
Yeah, absolutely. So there's not one size fits all solution here for businesses, particularly agencies that are essentially going to bear the brunt, maybe a delayed effect of COVID-19. So you really need to be looking at what's happening in your business now versus what's likely to be happening over the next 3 to 6 months, and then tailoring the solutions for your business specific to that. There are stand-down provisions available under the Fair Work Act, which a number of businesses have already used. They're really limited, so there needs to be an absolute stoppage in work before that right is triggered to stand employees down without pay. So it needs to be used with caution, and the potential, if you got that wrong, is that there could be an application in the commission. You could be ordered to repay wages that you haven't paid because the employee thought you could stand the employee down. And stand downs don't stop the clock on employment. So there's still an accrual of leave entitlements, of notice service for notice of termination and redundancy. So you really want to get a good idea of what's happening now versus what's likely to happen. Who do you think you need going forward? Because if you leave them on that stand down, you're not paying them, you may be eligible for JobKeeper, the clock is still ticking. And so a redundancy later could well be a more expensive proposition for you where the employees ticked over.
Yeah, leave still accruing and so forth.
Yeah.
There's some people out there that are talking about pay cuts, but still asking them to work their normal amount of hours. And this probably is not so relevant for the comm-only agents out there, but more the property managers and so forth. What's your response to that?
Yeah, so the employment law proposition, if you like, is that you can't unilaterally reduce an employee's salary without their consent. So you could do it by agreement. So, for example, if the business wrote to an employee and said, we need to cut costs, we need to reduce your salary by 10%, that can only be done by consent, technically. So you'd need to be getting a written agreement from the employee, certainly so you're not in breach of contract, and you might have potential claims, even underpayment claims later on. So definitely, if you need to be looking at that as a strategy, that's something you'd need to be doing by consent, and definitely your insurance policy is having that in writing. There's been a lot of discussion around that at the moment with JobKeeper coming in. And so businesses trying to work out, well, we've got 1,500 coming from the government each fortnight for each employee, and we've got a real mix of some people working lots of hours, some people not working as many hours. And we all know the ones that aren't working much and below the 1,500 per fortnight are going to get a windfall. In those scenarios where JobKeeper, you're qualified for JobKeeper and you're eligible for those payments, so hence why it's so important to get that proper advice from Business Depot, your accountant around that, is that then hinges on whether you can use the new Fair Work JobKeeper enabling provisions. In those, it's not a free-for-all, so you can't just start reducing employers' salaries to save costs. If you're using those new provisions, you can reduce hours, which as a result reduces the amount you need to pay the employee, but their base rate of pay is essentially protected. And there's a process you must follow to be able to utilise that. So it's notification and consultation. The fines are huge. So if you think, oh, I'm going to use the new Fair Work Act provisions without having JobKeeper, or you misuse them, the potential fines are up to 126 grand per breach. So you really don't want to be in a situation where you've misused them or you've applied them and you're not actually entitled to use them. So the Calm message is a very good one in terms of getting the JobKeeper process understood and right for your business, and then moving to, okay, can we now use the new provisions under the Fair Work Act?
Okay, so actually being eligible for JobKeeper is an important first step to being able to use some of those other, I suppose, employment law sort of concessions as well.
Yeah, those new they're called JobKeeper enabling directions, just to make it more confusing for everyone. But they are only available, those new provisions are only available if you qualify and continue to qualify for JobKeeper and your employees are eligible employees. So it's a really narrow group.
There's a bit more hanging on the eligibility even than the $1,500 then, depending on where we go from here anyway. Okay,
Can I just circle back to you, Justine, on one thing that you'd mentioned there, and just to sort of clarify, that thing about consent for people to reduce wages, and we've probably seen it a little bit because we've got property managers that are busy as they've ever been. The idea of reducing your costs by reducing hours it won't work because you need the property managers in there. If you get consent for everyone to reduce their wages and we get written consent and we follow those things through, how does that interplay with the award? Because I know a lot of businesses pay significantly above the award. I assume you still have to pay at least the award rate if you are reducing the wages.
Yeah, that's a really good point, Craig. So the key thing out of all of this is that, yes, we have some new flexible provisions that employers can use to manage the impacts of COVID-19 in their business by changing duties, changing location, reducing hours, all of those things. The core structure of employment law has not changed. So your employment contracts are still enforceable. The modern awards still apply. Under no circumstances should an employer be paying an employee less than what they're legally entitled to under a modern award if you're paying the modern award rate, or if you're paying above award, it's usually set up in an employment contract. That's why it needs to be done by consent to vary it, but you can never go below that baseline. So if you've got an award covered employee like the real estate agents, you cannot go below the modern award rate of pay for that level of skill that they're at. And if it's an award free employee, so it might be, I don't know, the managing director or some specialist, there's very few circumstances where an employee is award free, but if they are, you can't go below the minimum wage. So yeah, it's not a opportunity to be able to just slash wages. You've still got those underlying minimums that you legally must meet. Yeah.
Okay, let's get into the big meaty ones, and we've got a couple of questions on there already that are leading into this, and I'll build up, I suppose, the questions on this one. One of the questions on here, and I'll get you to answer this, Craig, is a commission-only agent able to access the JobKeeper payments?
Well, in short, yes. They're an employee, they're a full-time employee. Important distinction, though, in your business is to consider commission-only employed agents versus independent contractors. So I know there's some jurisdictions that can't have independent contractors, but for those businesses that have them, they're their own business. They've got to go through their own assessment process. They apply separately, but if they are an employed commission-only agent, they're an employee. They can qualify for JobKeeper. They are just remunerated differently than a standard salary and wage employee.
Okay, so and Justin, I think you've had a bit of a look at the overlay between the employment law and the JobKeeper and so forth. Do you think there's anything peculiar around, I suppose, application of commission-only agents for JobKeeper?
Yeah, look, I certainly think it's going to be more complex to nut out how you pay them. So the JobKeeper is designed essentially as a wages subsidy, right? So, and we all know you've got to have paid your employee before you get the reimbursement from the ATO. The wages condition that's sitting in the legislation to introduce it basically says the employer must satisfy that wages condition in respect of each fortnight that an eligible employee, which could be an agent on commission, is getting paid, and it must be at least $1,500 per fortnight. What we do know is that the wages condition includes wages and salary, but it also includes commissions, so as well as things like bonuses and allowances. So what we do know is that if you are an agency paying a commission to a real estate agent that is a full-time employee of your business, you can satisfy the wages condition by paying that commission. What is less clear then is that because it's supposed to be on a per fortnight basis, what happens if you're not paying the employee for a period of a month and then the commission comes in at the end of the month and you pay the employee at the end of the month? That commission can be used to satisfy the wages condition. The ATO legislation does indicate that the Commissioner for Tax does have scope to look at the application of those payments over different fortnights, but how they're going to actually administer that for the purposes of a commission is still not entirely clear. And as John had indicated, I diligently did try and call the ATO last night and stayed online for an hour, admittedly enjoying a glass of wine. And as soon as I asked the person over the phone the question, my phone got cut off. So whether they thought, oh, this is too hard to answer, or it was a technical glitch, I'm not entirely sure. But I think we're still waiting for some clarity from the ATO on that. But what we do know is that commissions are treated in the same way as wages and salary, at least for the purposes of that.
So Craig, you jump in here if you like to, but what we do know is you have to have paid $1,500 per fortnight. What we also know is that they've given the example of if you only do your payroll once a month, that you effectively can allocate that. I think the terminology was allocate that across the 2 fortnights and we would only assume that it has the same effect. Have you had much of a look into that, Craig, or you got a view on that?
Yeah, look, and we were having a chat about this last night, John, that the thinking, I suppose, is that the ATO have indicated that there is over relevant fortnights, and there are a certain number of relevant fortnights that land in a month. And for most fortnights, for most months over the next 6 months, there's 2 fortnights. I think it was it July that there's going to be 3 fortnights end under the time frame of these rolling fortnights that qualify for JobKeeper. And I think the guidance there is that if you've met the conditions for the relevant number of fortnights have been paid within a month, then you'll be okay.
Yeah, so we've still got this timing issue though, don't we, with commissions? Let's just run through an example, I suppose. Let's say I've got some contracts that have still been sort of sitting there waiting for the commissions to come through. And this fortnight, I've got a commission coming through. Let's say I'm entitled to $5,000 commission. If that's paid to the sales agent, we meet the $1,500 test for that fortnight. What about next fortnight though? What if I don't have a commission check coming in? Do you think we need to actually pay the $1,500 to them in that situation if there's no commission check?
Well, I don't think so in that case, because you've already paid at least 2 fortnights worth of wages to the employee during the relevant reporting period. So if it's $5,000, for example, there would be 2 fortnights that land within that month. Basic mathematics, $3,000. $5,000 covers off on the $3,000, and through your single touch payroll, well, you would have paid the minimum requirement in that period.
What if it was the other way around? What if you had the first fortnight, you didn't have any commission owing and you hadn't paid anything?
And the second fortnight you paid $5,000?
Yeah.
Well, if it's still in the same commission, in the same relevant period, but there's 2 fortnights, I still think you're fine.
Yeah. Do you have a view, Justine?
Look, only in accordance with what the rules say, being a typical lawyer, they're saying that the commissioner may treat a particular event that happened in a fortnight as having happened in a different fortnight or fortnights, if or to the extent that it is reasonable to do so in the commissioner's opinion. So I think might depend on discretion of the commissioner, but certainly if you can demonstrate that the commission payment has been paid similar to wages, it's still taxed, PAYG and all of that. There really doesn't seem to be any differentiation between wages and commission here. So if you've got an employee that you're ordinarily paying the more than $1,500 per fortnight, you're just paying them as per normal, and you're getting that wages subsidy. There's really
it's the intention, isn't it, that the employee gets the wage subsidy?
Exactly, and so you would think that the commission arrangement would operate the same. It satisfies the wages condition. We know that. It talks about wages, salary and commissions, as specifically referenced that in the rules, and that there's scope for the commissioner to go, okay, well, we can treat a payment in one particular fortnight for other as having happened in other fortnights. So going back to Craig's example there, if it's reasonable to do so. So how far they're going to let that go, I guess, is the question. If you're paying a $30,000 commission, for example, does that buy you so many fortnights going forward? I think the question will be, is that reasonable? And look, this is the way that real estate agents, if they've got a commission only arrangement in place, is how they're normally remunerated. So I don't think the intention of JobKeeper is to change that and see that the agent themselves benefits from additional payments. The intention is to subsidise the employer so that they can keep the employees employed. yeah.
Now, I mean, we know that Reef came out with their position on this recently, with their sort of their contracts when they're in place. And correct me if I'm wrong, guys. My understanding of that was that they said if it was a commission-only agent, you pay them the $1,500, and you didn't have the ability to offset it against future commissions. But if it was a debit credit agent, you pay them the $1,500, but it does offset against future commissions. Did I summarise that right, Craig, or did I miss something?
I thought that Reef had said that under their contract, even commission-only agents, if you paid them their contract, and that's a very specific to their contract thing, had clawback provisions for expenses paid on employers on their behalf. And I thought that they'd said that that would be able to be clawed back. Could be wrong.
The really key point there, isn't there, that obviously your employment contract is going to become really important here, and that there is no one rule, Justine, that we sort of can apply here. Start with your contract, start with the legislation, and have a look at it. I'm urging people to think, I suppose, big picture. What is the objective of the legislation? Are we achieving the objective of that legislation in how that we're doing this? And Justine, you made the point here. If it was just a salaried person and we still paid them $5,000 a month, we're getting $1,500 to supplement that as the employer, and the employee doesn't actually get a pay rise of $1,500. Where the complexity comes in, I think, though, is when you don't have a commission check coming through. The intention also is to make sure that these employees are getting $1,500 a fortnight still to live on.
Yeah, and certainly it looks like when you look at the wages condition and that extra wording they've thrown in the bottom, they've included the commission reference there with wages. They certainly have flagged that there's going to be scenarios where someone's paid something in a fortnight and then nothing possibly the fortnight before or thereafter, and that the commission can then treat that as having satisfied the wages condition for all of those fortnights. So look, again, it will depend on what's in a contract. You don't want to be in a situation where you're then in breach of those employment contracts or debit or credit agreements you have. So we definitely encourage you to go back and have a look at what the terms are and get advice on that if you're not sure. Hopefully the ATO will provide some clarity around that, because there's a whole industry that this is going to be an issue for. But it does seem to me like the way they've crafted the wages condition and the satisfaction of that they've contemplated this sort of thing happening. And you're right, it's a wages subsidy. The intent is to assist the employer, not provide a windfall to the employee, except for those employees that are really low paid, that are earning under $750 a week or $1,500 a fortnight. Yes, they're getting a windfall.
Getting a little bit of a top up. You got anything to add to that, Craig?
I think that's probably reasonably well summed up.
Yeah, well, I know from a practical perspective with the clients that I'm talking to, they're looking at it, they're looking at their options, and then they're making a commercial decision as to how they're going to apply it. For example, some might be saying that they are going to pay the $1,500 if there's no commission check in that fortnight, but they're then relying on their contracts where there might be there might be some terms in there around deductions or overpayments or different things like that to enable them to offset that against future commissions. But one of the big commercial considerations here, Craig, is we don't want people building up a huge amount that they've sort of taken in advance, because we all know what salespeople do when they do that.
Yeah, and that's for your sales agents that are usually com only, but also for your debit credit agents. So, you know, there's different clients doing different things, but I'm aware of some clients where they've got their debit credit arrangements. They are getting some they will get some subsidy from JobKeeper. They are probably likely to still notionally in the first instance have the full amount of their debit credit arrangement being carried forward, but they're mentioning that they're likely to waive the amount that has been subsidised by JobKeeper, mainly because they don't want to get to 6 months' time and have an agent that owes them 20 grand in retainer debt and just go, you know what, it's just easier if I go to the agency down the road and I'll start again. You know, they don't want to have supported someone through this phase of trying to sell property, only for them to back up because 20 grand will take them forever to pay back.
Okay, Greg's got a question.
Decision of theirs rather than any requirement necessarily.
Yeah, Greg's got a question here. Sorry, you got something to add there, Justine?
Yeah, sorry, John. I was just going to say, look, there is an element of commercial risk in all of this for all employers at the moment until we get further clarity from the ATO on some of these issues. They're certainly alive to them, and this is a whole industry issue. The last thing we want is employers, as Craig indicated, being in a situation where they've overpaid employees, and the difficulty in getting that back is key. So I think it's one to certainly keep a watching brief on, and as soon as we can get clarity on that, we'll certainly do an update through Business Depot and My Practice as well. But yeah, there's commercial risk on this whilst it's being implemented, there's no doubt, for employers.
Okay, so we've got a question from Greg on here. Are there any complications with applying? If, as we do, pay mid-month and end of month, should we just average to fortnight over the last period? I think that's that allocation. So the rules actually talk about an allocation, and they clearly within their example say that if you're paying not in those precise fortnights, that you can allocate or attribute to those fortnights. Now, Caesar's got a question, and for agents who do have COM not coming that often, then one of the requirements is that they are receiving the $1,500. So if they don't have a lot of commission coming down the track, then you're going to have to make sure they're getting the $1,500 if you're going to get the $1,500. And
that's where the commercial, well, that's just where your commercial risk comes in about, are you considering basically recording that as a debit credit that you'll recoup from them later on, or is it just going to be passed straight on? That's a commercial decision that the business needs to take, but the obligation is clear that if you are getting the JobKeeper payment for that salesperson, then you have to pass, you must pay them at least $1,500.
Yeah. I'm loving doing these webinars because every webinar we get some doozy questions that sort of throw me or something I haven't thought of before. And there's one here from Alex. Question on super with commission only. And if no commissions for the month and they receive the $1,500 a fortnight, do you pay super on the $1,500? Now, where this question's coming from is if you top up an amount, you don't have to pay super on it. Or if you stand someone down and just pay them $1,500, you don't have to pay super on it. Do you have any thoughts on that one, Craig?
Well, I think it probably depends on what your commercial intention is. If your intention is to carry this as essentially a debit credit arrangement, in the future, when you deduct from commissions, the commissions that are earned, you have to pay superannuation on that. So that if you now are paying $1,500 to them, you intend to withhold from the commission they earn later on, then I think, yes, you'll have to pay superannuation.
What do you think, Justine?
If your intention is not to recoup it, then it is purely a top-up, and if it's a JobKeeper top-up, you don't have to pay super.
Do you have a view on that one, Justine?
No, I agree with Craig on that. So yeah, if you're just passing it on, you're the vehicle to pass it through, there's no liability for super. It's where the employee is actually working and otherwise being paid that there's obligation for super arises.
Lisa's asked the question, I need to pay a commission-only agent $6,000 on the 20th of May. They have nothing prior to that. How will that work with JobKeeper? Well, if we look prior to that, they won't have received anything in April then by the sounds of things, and they really need to have received the $1,500 for each fortnight in April. So again, I'd be reading your employment contract, wouldn't you say, Justine, to make sure if you do pay the $1,500 now so that you can get it back, assuming you meet the 30% decline test, that you can pay that in advance of that $6,000 next month.
Yeah, I think the discretion to pay the payments sort of not in the fortnightly run is just for April, isn't it? So they'll accept that so long as you pay by the end of April.
Yeah.
If you're claiming, if you're then claiming in May, the expectation would be that you are if you're receiving that money from the ATO, it must, in order to satisfy the wages condition, it must be paid to the employee. The unclear part is that yes, the commission can be included in that, but how long between commission payments is going to be reasonable for the commissioner of the ATO to accept that commission has happened in a fortnight where you would otherwise pay the $1,500. So I think it's one that it probably does need some specific advice and certainly clarity from the ATO here as to how they're going to accept and treat that.
Given that there's talking about they will say, or they'll provide information monthly on who they think will qualify based on single touch payroll. If you go through a month and you paid someone nothing, I don't think basically my understanding, they'll offer you $3,000 or 2 fortnights worth of someone because you haven't got anything paid to them through single touch payroll. So I think in that sort of situation, it's going to again go back to contracts and go, I'm going to pay you the JobKeeper $1,500 a fortnight during the month of April. And then when you get your $6,000 commission toward the end of, I think, 20th of May, will those amounts that have already been paid be something that gets basically offset against that $6,000, and you will be 3 fortnights up to then, you will have already been paid $4,500 of your $6,000. And I think that's going to, again, come back to a contract issue. You're going to have to check your contracts.
And Susie's quite rightly put a comment on here saying that Reef's advised them that with commission-only agents, that you don't get the $1,500 back like a debit credit in the future if you pay it. I'd suggest that it really comes down to your employment contract in that regard, and we absolutely don't have a clarity of view from an ATO perspective in this regard. But what does that result in the agent effectively getting an extra $1,500 in that situation? And I don't know that that's necessarily the objective either.
Yeah, well, and they'd get an extra $1,500 there because you've got no ability to recoup from them being paid more than you're obliged to pay them. And I think, look, the intention is quite clear all the way through the government announcements right through to the ATO documents. This is a subsidy for employers rather than, other than those that Justin mentioned that already usually earn less than $750 a week. Other than that, it's a subsidy for employees to keep the lights on.
Yeah. A couple more questions in here, and then we'll allow you to go and answer all your other phone calls you've probably got to answer, Justine. We've done that one. Commission. What about when no commission is payable, however, the employee receives a retainer to be deducted from future commission? I think that $1,500 comes out of that retainer, and it's part of that retainer in that situation, Greg. If someone was laid up, here's one for you, Justine. If someone was laid off at this time, they said due to not meeting targets, only one warning given, and then they were made unemployed. Is that legal?
So I think the key reminder out of all of this is that the employment law structure and landscape that we've all been living in previously has not changed. What we have seen is some temporary flexibility provisions coming in to allow employers some more flexibility to respond to the impact of COVID-19, because there are a number of roadblocks and restrictions in terms of what employers can do to take entitlements away from employees. That's how our system is set up with modern awards and those protections. So if you've got an underperforming employee, there's nothing in JobKeeper, there's nothing in the changes to the Fair Work Act that prevent you from still dealing with that performance issue or that disciplinary issue, and potentially looking at a termination of employment. The unfair dismissal laws still apply, the general protection laws still apply, breach of contract claims can still be made. And so whatever your normal process is to administer HR elements in your business should still stay. Same when employees decide to absent themselves. This is not all bets are off for employees to just stay at home and do nothing.
Yeah.
There are still legal obligations that they must meet back to the employer. So the short answer to that, after saying all of that, is that you just follow your normal processes. If you've got grounds to terminate an employee, there's no hard and fast rules around how many warnings you must give them. Depends on the individual case, the severity of the conduct, again, your contract, what your industrial instrument might allow to affect a termination. And any of the agencies out there that are doing that, should always be looking at protecting the agency itself from these types of claims and going through whatever that process needs to look like.
Okay, a couple of quick fire questions for you, Justine. How to transition someone from full-time to part-time, minimum hours per day on part-time. Is it right that you just got to keep the hourly rate the same?
Yeah, so JobKeeper there's no scope whatsoever to change the base rate of pay. So we know that there's the wages condition. There are also conditions around not changing the base rate of pay for an employee calculated on an hourly basis. So if they're a salary, you work that out. You can reduce hours, but remember you have to qualify for JobKeeper. Employee must be an eligible employee for it. And then you've got to go through a notification and consultation process. If you don't have work there, you can reduce hours only, not rates of pay.
Okay, another one here from Nikki. Is it lawful to reduce debit credit agent hours and wages by 20% at their request? So someone's come to the employer and said, I want a pay cut of 20% hours and wages so that I get access to the superannuation.
Yeah, so you can agree to variations to the employment arrangements. That's a variation to the contract. Again, we'd have to have a look specifically at the debit credit arrangement, but if they're an employee with an employment contract, there's an agreed variation to reduce their hours and salary by 20%. So long as you're still paying them the minimum that you're legally required to under the modern award, you could conceivably do that, but you'd need to be checking, your documentation that relates to that particular employee.
And one more for you from Vicky. So Justine, are you saying if a property manager is at home not working, do I have to pay them a top up from the JobKeeper to their usual salary?
So, okay, there's a bit in that one. So
Yeah.
If the employee is at home and not working, I presume you've stood them down or you've granted them a period of leave without pay. And in those circumstances, you won't have been paying the employee because they're not working any of the hours. When JobKeeper comes in, if you're eligible for that, you just simply pass that on to the employee. If you decide, and a lot of employers are doing this now, we stood them down early or we made them redundant and we now want them back and now we can afford to have them in the business doing stuff, we're going to bring them back. You've still got to pay them at the hourly rate for the hours that they work. And then the difference up to the 1,500 may be something that needs to be topped up by the business.
I know I said that was the last one, but one more just popped up that I thought you might like to answer. If someone is working casually, say 10 to 20 hours per week, and so they get a top up to get to the $1,500 a fortnight, can you ask them to work more hours to justify that top up?
Yeah, this question's coming up a lot, and I'm sure everyone's seen the unsavoury text messages that were publicised yesterday from a dress boutique in Adelaide, where there was a bit of a to and froing with an employee about the extra hours they were required to work to get JobKeeper. Again, all of those rules in the modern awards and your contracts still apply. So if it's a casual employee, you might have scope to change their hours each week based on roster notifications and timeframes under the award. If it's a part-time employee, it is dependent on what you're able to do in the award. You may need to get a written variation. You may need to give them notice to change those hours. What you don't want to be doing is having a part-time employee working more than their ordinary hours and you end up with an overtime claim. So again, you've got to go back to your industrial instrument and check what you can do there.
Okay. Thank you very much, Justine. We're going to excuse you, but please, everyone else, stay online. We're going to keep discussing some of the other things that are relevant around COVID. We'll just excuse Justine from that employment law sort of side of things. So thank you very much for your contribution once again. Great leaning on your expertise. You're such a guru in this space and really appreciate you adding your 2 bobs worth to it. Thank you, Justine.
Thanks, John. Thanks, Craig.
Thanks,
Thanks, guys.
Cheers.
So Craig, let's dive into some of these other issues now that are relevant for the real estate industry. What's the other big ticket item that's going on at the moment, I suppose, with by way of stimulus?
Probably the big ticket one is the cash boost payment, which is linked to your March BAS. And there's been a development on that today as well. There had been some guidance from the ATO about when you should lodge to access cash refunds, and we probably should give the detail first, but that's updated today, so we'll cover that in a second. But essentially, they've said that for your March BAS, there will be a credit that is applied to your ATO account for, depending on your lodgement timeline, but it can be, if you lodge your tax on wages monthly, they will give you 3 times the credit of your tax withheld on wages in that particular BAS, up to a maximum of $50,000, which will be offset against the rest of your BAS liability.
So if you deduct 10 grand a month from your wages, so 10 grand a month of PAYG withholding, you lodge your March BAS, you get a credit of $30,000.
Yep, a credit of $30,000 towards your BAS. Important to note, it's just not an automatic refund of $30,000. I think there's a little bit of misconception early on, but it's a credit towards that BAS. Now, if you'd, on top of that $10,000, collected $20,000 of net GST, your usual BAS liability would be $30,000. You've now got a $30,000 credit. You don't pay anything on lodgement of the BAS.
Which basically means that money you put aside for GST and PAYG withholding is now yours. Yeah, you don't actually get a payment though.
Correct, but I'm seeing a lot of businesses that do use tax provisioning accounts and they've been pushing that money aside month to month. but they're now bringing that back out of their tax provisioning account into general to fund general working capital. Conversely, you know, if your net GST is a bit higher or a bit less, you'll either pay a small top up or you may actually get a refund.
And are you seeing some of those refunds flowing?
A couple. And then the ATO had said if you want, you know, if you want the refund to come out and you have an existing debt on either your income tax integrated client account with them, don't lodge until after the 28th because the credit will automatically be applied against your existing debt. This morning actually, they've changed their guidance on that. They have updated their systems a bit quicker than what they expected, which would be a first. And they are now refunding regardless of whether you've got a debt. So they had said wait till the 28th. If you're in that situation, they're now saying, no, it's okay, we've got it sorted, you will get the refund. But for those that didn't have a debt and are entitled to a refund, I've had a couple come through. The reality is for most businesses, they are not getting a refund. They are going to get a lower amount that they have to pay on the BAS. So, you know, the rush to lodge the BAS isn't really there. We just still got to lodge it by the due date and pay less than we ordinarily would. But
and I suppose just for completeness, the minimum is $10,000 on this BAS or this up to 30 June, and the maximum is $50,000 that you could get back. The same, whatever you get in this period, you will then get again next quarter, so that the overall minimum credit will be 20 and the overall maximum will be 100 over the entire period through to 30 September.
Correct.
Any other big ticket items on the cash boost that you think people need to know about?
Look, probably only just really the timing. If you lodge this March BAS and you get a $50,000 credit on that, you won't get any further credits, say on the April tax withheld from wages or the May tax withheld from wages. The next credit comes through on your June BAS and you'll get a quarter of what has been claimed over that period, so $12,500, and then you'll get 12,500 over subsequent.
So if you don't use the whole maximum 50 grand in the March BAS, you keep getting it until it adds up to that $50,000 by the end of June.
Yep.
Okay. And what about independent contractors, mate? What are you talking to independent contractors about? Because they sort of missed out on, most of them missed out on the cash boost payment. What are you saying they should be doing from a support or stimulus basis?
Well, some of them would have got some payment from the cash boost because they'll have some employees. They might have, or some of them have some employees. They might employ directly their PA or a sales associate. Not all of them, but some of them. So they will get some benefit on the cash boost. But probably circling back to the JobKeeper, they are their own independent businesses, so they should be assessing their turnover or forecast turnover and seeing whether they qualify for JobKeeper, because even if they employ no one, they may qualify themselves as a business associate of that independent contractor company, usually company, and they may be entitled to get $1,500 a fortnight for themselves out of there, regardless of whether they take a dividend or a wage out of their structure. Important to note, it's limited to one business associate. So, you know, it's not a husband-wife, it's husband or wife if neither of you are getting a wage. If you're automatically paying a wage, then it'll roll through anyway.
What are you saying to those people where it just so happens that, let's say, the wife is getting a wage and the husband hasn't been getting a wage? Do you think the husband can get as self-employed even though the wife is getting a wage and getting the JobKeeper?
Yeah.
Yeah, I mean,
the wife's an employee. She's not a business associate. There's nothing to preclude that. I would just say that, you know, very, very, very good forward tax planning there.
Yeah.
Healthy dose of luck as well.
One of the other big things we're talking to people about is when you think about the big three in your businesses, you got your wages, you got your debt, and usually it's your rent. Yeah. What about the debt with the banks? What are you seeing people doing? What concessions are they accessing?
Well, a lot of people have gone to the banks reasonably early to get concessions around repayment obligations, whether that is if you are on principal and interest, at least not paying principal for a period of, you know, normally around about 6 months by initial agreement. Some people are still continuing to pay the interest because they don't want their debt to grow. A lot of banks do, though, have the option to capitalise your interest. I think it's still, you know, they'll be assessing their risk a little bit on whether they determine you can capitalise your interest or not. But, you know, open and early discussions with the banks on existing debt is fairly important.
It's probably a really important point to make, isn't it? So a lot of these concessions from the banks, look, and appreciate them giving the concessions, but they're pushing the repayments down the line. They're not actually waiving any interest or anything, and that interest is still accruing.
Yeah. And so, if you find yourself, if you are in principal and interest at the moment and you at least stop the principal, that can be a reasonably substantial cash saving, which, you are then just paying the interest that is charged every month, and at least your debt's not growing. So probably seeing, it's a bit of a mix, but some people are just parking the principal at least and just continuing to pay the interest so that they don't have a growing debt during this time.
And one of the other
cash flow.
Yeah, one of the other government initiatives was the federal government supporting, I suppose, unsecured loans by providing security to up to 50% of a loan, which is actually delivered through the banking system. Are you seeing much traction with that? Are you seeing much coming out of the banks with that?
It's not been easy. We've got a couple of clients that are going through the process, and a couple of clients that, some of the banks were almost throwing money at before to go through this process. They've really, really had to work it hard. More on a serviceability perspective, the banks are still looking really closely at your serviceability. 50% of it might have been guaranteed by the government, and the other 50% is still unsecured lending. So they're looking to see what can you pay, and they are very closely looking at what you've been doing gross commission historically. And, I've heard them saying things like, if you did half the amount that you've historically done, how does that stack up from a serviceability perspective?
Yeah, there's still unsecured loans at the end of the day. Some of the banks haven't even come out with what they're going to offer in this regard, and so I'm a little bit struggling to get too excited. And part of it's because of the term of it. It's a 3 year sort of term. You might have, no repayments for, I think it's 6 months or 12 months.
Yeah,
6 months, was it correct?
I think it's 6 months, and there's an interest only for the next 6, got to be repaid by over the following
3 years.
And regardless of if it's unsecured, typically you're going to a bank that you already bank with, and they already have security with you over an existing loan. So, look, it may be unsecured, but is it really, if they've already got you for everything else anyway?
Yeah, I'm struggling to get excited. And I think that's why the serviceability is sort of struggling, because there's only 2 years to repay up to a $250,000 loan, which means you've got to make a lot of money before tax to get that repaid. What about the ATO? What concessions, what support are you seeing getting from the ATO?
Look, credit to the ATO. They are being fairly good around relaxing the time frame of paying payments to the ATO. So we've had some clients that have already been on existing payment arrangements, for example, and they've put a halt onto requiring payments for up to about 6 months. So often people are looking again at having to resume payments in September, where they are on an existing payment arrangement. But for a number of businesses, probably the bigger support is if you are paying quarterly instalment towards your current year estimated income tax. The tax office have said that you can choose to vary your instalments down to nil and not pay a tax instalment. It's not a bonus in terms of it's not an overall saving, but it does mean that you are deferring paying your tax until later. And the concession there is if historically, if you've varied your tax instalment and you significantly underestimate and have to pay an amount on lodgement of your tax return, the tax office can hit you for penalties and interest. They've said that they'll waive that this year, even to the extent that if you paid some instalments so far, you can apply to have those refunded to you. But when you lodge your tax return, you're still going to have the tax debt.
Yeah,
it can help you from a cash flow perspective, but it's all about, if you need that to manage your cash flow, that may be an option you look to take.
I'm a little bit worried about how all these things are accumulating down the road here.
Yeah, look, a lot of clients are not necessarily asking for refunds of tax already paid, unless they are having a significantly worse year than what's happened in the past, and can see that over the next quarter, particularly, they're going to have a bit of a stinker. But I'm probably seeing more clients in this quarter choosing not to pay an instalment with the option of getting some level of refund on the June BAS if their taxable income is significantly different to what the instalments would imply.
Yep. And obviously for completeness, we'll mention the state government sort of concessions. Most of the states have done something around payroll tax, land tax. There's a whole range of different things. Queensland, they've done some refunds of payroll tax and some deferrals.
Yeah, Victoria has done a refund of any payroll tax paid relative to relevant for the 2020 financial year, and you don't have to pay for the rest of the financial year, although you'd have to lodge. And then for small businesses, there's also a deferral on the July, August and September months that they won't chase those until after October, I believe. For those that don't get payroll tax benefits by having that refunded, the Victorian government's also offering a $10,000 grant. The catch there is, and I came across this just the other day, was that there was a client of ours that was registered for payroll tax, but they weren't paying enough wages to have to pay payroll tax, which was a $650,000 threshold. So they applied for the $10,000 grant because that's capped at $650,000. They were registered for payroll tax, so they didn't get the refund. So the advice from the SRO down there is be registered for payroll tax, which is not usual because they normally, once you're registered, they want you to stay registered.
Yeah, I mean, I know New South Wales has got some $10,000 amounts as well that they can get as payments as well. On our main COVID blog, which is at the top of our blog page on the website, if you go in there, there's a hyperlink to every state. We've summarised all the different concessions from all the different states. I suppose also to cover off on completeness and that other big cost that many real estate businesses have, and that's your rent. Also, I'll just direct you to our website on that. There's some great content on there from Rob Shepley from our legal team talking about the code there for commercial premises. There's also, we also did a Calm COVID Convo on commercial tenancies as well. So you can watch the recording of that on there as well. Notably though, that's not legislation yet. And your landlords, the codes are requiring things to sort of start to happen, even though it's not legislation. I don't think anywhere yet.
No, and look, I'm hearing some mixed things from clients out there. Some landlords are working really well with some of our clients, and others are, they're offering some pretty token support so far.
Okay, let's jump back into some of these questions that we have on here. I don't know whether you know the answer to this one, Craig, but Jackie's asked, I have a girl, Craig. Sorry.
I have a beard. Come on, I'm trying to look like a real man.
I have a girl on maternity leave and she's due back in September 2020. She's already finished government leave and she has asked me for JobKeeper. Is she entitled to get it even if she's on maternity leave? And if she does get it, does she have to work a certain amount of hours to make up for the money? Look, I believe they don't get JobKeeper if they're on maternity leave.
No, I think they might. If they're on maternity leave that's not supported by paid government leave, like if that's expired,
yes,
I believe you actually do get it. So that's probably the key thing there. If they are still getting the how many weeks is it? Is it 18 weeks of paid maternity leave from the government? If they're beyond that, and they are still on your books on leave, then I believe they do get the JobKeeper, and I don't think there's any scope for you to then ask for them to work it off, essentially.
So Jackie, you might reach out. We'll put you in contact with Justine on that one. She might be able to help you from a employment law perspective as well. Got a question. ATO is offering instant asset write-offs now. If I buy a $30,000 car for work, what does that mean? Yes, there's instant asset write-offs before 30 June of up to $150,000. Notably, you can't go buy a $150,000 car because there's a luxury car tax limit of about $57,000. If you had a logbook to show that that car is 100% business use, then you would be able to get an instant asset write-off of that $30,000. Did I get that right, Craig?
Correct, yeah. And so there was probably a bit of excitement earlier that people had a bit of cash up their sleeves and they'd been eyeing off a C63, but it's unfortunately the motor vehicle industry lobbied the government to have the luxury car tax limit waived in this case, but there's been crickets from that. So it's $30,000 car, logbook key, if it's 100% business use, logbook key to make sure you can claim that full write-off.
We've got a question on here. Can I confirm whether the cash boost comes off outstanding debt? So the position on that, which was clarified today, the processing has had the system allocated against existing debts. They've now said that it'll only be offset against the March BAS that you are lodging. Correct, Craig?
Correct, yeah. So if you've got an overall credit on the March BAS as of today, regardless of whether you've got a debt on your account, it'll be refunded to you.
Yep. Lee said that he's got a PAYG liability of $1,922 on his March BAS and an 8K GST bill. Does that mean we get a credit for 3 times 1922 to apply against the March BAS? Yes, that's exactly right, Lee. That's exactly how it will work, except you will get more than 3 times 1922 because you will get the minimum of $10,000, assuming you meet all the other eligibility requirements. Julia, do we know if payroll tax will be payable on the JobKeeper portions of pays? I actually don't know the answer to that one.
Well, it's a good question. I would assume it would be. I mean, it's still a usual payroll. This is a subsidy towards your payroll, but you're still paying wages. There's still taxable wages.
It's still taxable wages to take tax out of your $1,500.
Yeah, I haven't seen any guidance from the various offices of state revenue, but I can't imagine that all of a sudden that's not counted as wages. Because, I mean, there's already for a number of jurisdictions, you're not paying payroll tax on it anyway for at least until June, or it's deferred if they're less generous.
Daniel's asked if we have an employee who is claiming JobKeeper from another employer, so that highlights that you can't have a casual employee claiming it from 2 employers and need to choose one or the other to get it from. Do we need to keep this employee? Is this a special stand down or a redundancy? I don't know about that. I think you'd have to refer back to someone like a Justine as to your normal fair work rules as to whether you can cease them being an employee. You might be able to use the JobKeeper provisions that Justine was talking about earlier.
Yeah, well, you'd be an entity that's getting it, I assume.
Yes. If it looks like we will be eligible in April for the 30% reduction, when will we know if we have been approved by the ATO? Would it be before 30 April?
Well, I think, isn't it like you're lodging your tax return? It's basically you lodging a statement that you have dropped 30% is saying that you have dropped 30%. They will then process it on that basis, and they will have some level of compliance activity in the background. So you think about your lodger tax return, they assume it's correct. They may review it later, and if it's not correct, they'll come back and go after you. So if you lodge it effective 1 April, you've got your single touch payroll stuff all lodged, and you've done the application process correctly. I think you've got the 4th of May, is it, that they're going to release the next step of here's your employees that you are entitled to get it on, and you complete that documentation and they'll refund it.
Yeah, think of it, it's a self-assessment system. So if asked, you've got to prove it.
Yeah.
So some of the things we've been doing for people is if we've had some conjecture as to the calculation of a 30% drop, maybe the questions around what you're including in income or not including in income. Firstly, the tip is make sure you're doing it on the same basis. But what we've been doing is we've been doing a couple of calculations based on different scenarios to see if it gets a different result. If it does get a different result, then it becomes a little bit of a risk assessment. The question that ties into my next question from Jess. If I've predicted we will drop by 30% in April, have nominated for JobKeeper, but then something happens that means we aren't eligible after all, does it just get declined, or will we be fined?
Well, it might depend a little bit on how much you miss by. The tax office and the Treasury have had pretty clear guidance that if you estimate that it'll be under by 30% and you just miss, then there'll be some leeway to be for them to be kind and not request repayment. But they haven't quantified what just missing means. If you lodge and register from April, that effectively you're saying that you've either qualified from an expected April drop or a June quarter drop as well. So if you're going on the basis of April and you just exceed for April, you can still look at, are we going to make it for the full quarter of June and still qualify there? So, there's the 2 scenarios you need to look at for that. But yeah, I believe there is something in there about being able to recoup JobKeeper that shouldn't have been paid, but there's also leeway if you just get it a little bit wrong. But we don't know what a little bit means. Yeah,
we don't know what that is. I mean, in my head, I sort of go, if we're 3% out, I'm not expecting them to go down hard on us. And some of the commentary I've heard from the ATO is that they want to pay these amounts. And they're not looking to trick people into thinking they're getting something and they're not actually getting it. But we have to make sure that people don't get a bit too gung-ho with this. And I've had a lot of discussions around whether they morally think they should be getting it as compared to whether the calculations show whether they should get it or not. And I think, there will be some element of risk assessment that comes out of this. Julia's asked, can we defer the balance of March BAS, Craig?
Yeah, well, you've just got to actually apply for it, but yes, you can apply for it with the ATO, and they have been very good with deferring existing payments for clients. I don't see why they won't do it again. They may still take into account things like your lodgement and payment history, and if you've historically been a poor payer, they may make it a little bit harder, but there's nothing that's preventing you from.
You still got to get that deferral, don't you? You still got to tell them.
Yeah, you've got to ask for it. It's just not a given that it'll be done. You need to ask for it.
Ange has asked, I like this one, can an employee delay the start of their government paid parental leave in order to get the JobKeeper and then commence their paid parental leave after the JobKeeper period? There is some specific parts of the legislation, and the terminology they're using is contrived. And basically they've said if you do something which is contrived to get a benefit from JobKeeper or cash boost, then the ATO might disallow the whole thing and expect them to go a little bit harder on you, I suppose. But I don't know the paid parental leaves provisions that well as to whether it's something you can delay the start of even.
Well, it might depend on whether you've actually applied, because there's a reasonable sort of process of application through government bodies. If you all of a sudden withdraw it and there's JobKeeper and then you reapply later on, there could be a fair element of risk there.
And I'd just like to emphasise that contrived thing, because there's a certain amount of data. The ATO's got a lot of data on your businesses now. They've got your BAS data, which that little G1 cell, which hasn't meant much over the years, is now a very important cell of what is your sales in the period. And they've now got your single touch payroll. And so with payroll going through automatically to the ATO, it's not like you can turn things around or back out wages and things that, because they're getting it on a live basis. So you've got to be very aware of what they're going to be getting. And and what is contrived is going to be really interesting. Jess has asked, can we renominate in May if we miss out the 30% test in April?
Yes, you can. You can nominate. If you expect that you're only going to make it in May, you can nominate in May and name May as the month that you qualify from.
Because again, it's quite interesting that this is based on projected turnover, isn't it? The only thing I'd say to you, Jess, is if you project to qualify for the whole quarter, then you can get the JobKeeper payments for April now, even if you don't meet it in the actual month of April. It's only those people who don't meet it in the month of April, don't meet it in the quarter, that then meeting it in the month of May become relevant. Okay, Dale, just trying to get my head around debit credit salespeople. Would you recommend only debiting their ledger balance for the difference above $1,500, meaning the business? I think it really comes down to your agreement again. Craig, you got anything else to add to that one again?
No, I get just like you, I'd refer to your agreement, but also take that commercial view of it and sort of go, look, if you think that someone's going to come out the other side with 20 grand retainer debt and then they'll walk away because they're thinking that's too big a hill to jump over, do you really want that sort of situation? You might decide that you will just debit the difference.
Yeah. How do we advise the ATO of what our forecast is to show a 30% drop? You just go on the web, on the ATO portal, so the business portal, or through your tax agent. It's really easy. You basically tick a couple of boxes and say that I am eligible and my turnover declines by 30%. Interestingly, there's a question in there as to when your turnover declines from, and I did something wrong the other day because I was qualifying for the quarter, but the question is very specific and saying what month does your income decline by 30% on. It wasn't until May that it declined, but you need to answer April if you wanted to apply for the whole quarter. So
it's worth mentioning there though, John, you don't have to provide that to the ATO now, but there is an obligation on you to have kept reasonable records to support your assertion that we will drop at a certain period of time. So in the background, although the form itself is a really easy form, and we've got some really detailed work papers we built around supporting and having that on record, so that if you're ever reviewed, particularly if you don't meet the target, that you've got all the workings there to show that you had a reasonable expectation that you'd make it.
Yeah. Kelly's got a question. JobKeeper lasts till September. Optimistically, what if you register for it and then in a couple of months we are back to normal and our income goes back to normal levels? What do we do then?
Well, I mean, they haven't said that they're going to pull the program.
They've actually gone to the extent of saying once you're in the program.
Yeah. Well, once you qualify once, it's right through, and I can't imagine that they're all of a sudden going to go, oh, July, everything's back to normal, so we're going to pull the program.
I'm just really, really curious, because one of the reporting requirements is that you have to lodge your monthly income within 7 days at the end of the month. What if your income skyrockets at the end of the month for some reason? Or what if, we go back to normal and restaurants open and everything again? They haven't said that they will then stop the payment or ask for any payments back. They've actually gone to the extent of saying once you're in, you're in.
And I think partly, you mentioned before the amount of data the tax office has on you, John, that requirement monthly to put in your payroll, sorry, not your payroll, your turnover. As much as anything, if your income skyrockets, you may just be at a higher risk of being reviewed for have you contrived an arrangement here to get through.
Yeah. Guys, I know we are well and truly over time, but I wanted to make sure we covered off on all of these different components and answered as many questions as we possibly could. I know we haven't got to everybody, but we'll reach out to you. If there's anything we haven't answered there, we'll be happy to try and answer that for you where we can after the event. So I'll have Bradley Dean from my team reach out to you if there's anything left unanswered. Maybe to wrap us up, Craig, I want to bring it back to business. Because all this support and all this tax stuff, that's one thing. But at the end of the day, we've got businesses to run. What are you doing with businesses from an overall, how do you still get through this from a business perspective and be as strong as you can on the other side of this blip?
Look, it's probably not a different message than what you're saying in any good times or even any other bad times. It's don't be an ostrich. Keep your head out of the sand and understand your numbers in your business, because although there's some stimulus here, you may not have to pay as much GST as ordinarily and your wages may be subsidised. If you don't know the true numbers in your business, you can't really plan for it. And although this stimulus is here to help you get through, you want to have a business that does more than just get through and is in a position to be able to thrive later on. So I'm talking to my clients about how important it is to really and truly know the numbers within your business, and knowing that helps you make some decisions. If you need to cut some costs somewhere, you can make an educated assessment as where you cut the cost.
You're saying it's cool to be an accountant in these times, Craig?
What do you mean in these times? It's always. Nothing's changed, John.
Look, I think that's really good, solid advice. And however you go about doing that, whether it's break-even point or whether it's thinking like a startup a little bit more and thinking about, well, how much money do we have in the kitty? If we're not making money, how much are we burning? And therefore, what's our runway? Just like a startup sort of things when they've only got a certain amount of money. And
those two things are really linked, John. Like knowing your cash burn rate means you need to know what your monthly fixed commitment to costs are. And I love a break even. That's when I get my ultimate nerd on and slip between the spreadsheets, but it's more valuable than ever.
But the key message being don't be an ostrich. I suppose I'd add one more thing. My tip to people would be now is your time to shine as a leader. And as a principal within your real estate business, you've got an amazing opportunity to really build rapport with your team, really display your values, really build your culture during this time. And I never like to have a discussion about the numbers without a discussion about the humans, as you know, Craig. And so that'd be my added sort of business tip, I suppose, at the end there.
Well, I mean, we always talk about real estate businesses being people businesses. It's the engine that drives your business, but also it's your customer facing thing. It's all about people. So yeah, good advice, John.
Again, everybody, thank you so much for joining us. We're hoping these are valuable to you. We're doing these trying to do these in a very casual, conversational sort of way so that we can just have a discussion. Some of the things, unfortunately, we don't have black and white answers to. Unfortunately, some of it is grey, but let's at least talk about the different ways to think about these things and the different things that we're seeing out there. If it is black and white, we'll give you the black and white. If anyone does have any questions, or if anyone needs help with their JobKeeper applications, or you're not quite sure how the cash boost is going to work for you, any of that type of stuff, we just want to help you guys get through this time so the industry is stronger when we get to the other end. Any final words of advice for people, Craig?
No, I think know your numbers and stay calm. Make calm decisions, and that's how I guess we call these Calm COVID Convos.
Yeah, I've got to slow down when I say that as well, because I'm going to blur my words. If anyone needs to, there'll be a recording of this webinar available on our blog on the website. You also, if you go to the top of our blog, there is our main COVID blog where we've got links to all the webinars, all the other information and so forth that we've got available. The shortened link for that is bit.ly, so bit.ly/BD COVID updates. Go to that and that'll sort of guide you through to everything else you need. Keep an eye out for some of our future webinars, Calm COVID Convos. We're going to start to change it up a little bit, start to focus on the other side a little bit more. We're going to have some discussions soon around the opportunities and the marketing opportunities and different things like that in the next little while as well. So thank you, Craig, and thank you everyone for joining us.
Thanks, John. Thanks, everyone.
See you guys.